Finance and accounting are two closely related fields that are essential for any business organization. Finance refers to the management of money and investment, whereas accounting is the process of recording, classifying, summarizing financial transactions. The primary objective of finance and accounting is to ensure that a business organization is financially stable and profitable. In this article, we will discuss various aspects of finance and accounting, including their importance, principal tools and techniques, and their role in decision making. Importance of finance and accounting. Finance and accounting are crucial for any business organization as they help to ensure financial stability and profitability. They enable an organization to make informed decisions. Finance and accounting provide the necessary information and data to make informed decisions about investment, acquisition, and business operation. Monitor financial performance. Finance and accounting help to monitor financial performance by tracking revenue, expenses, and profit. Manage cash flow. Finance and accounting are essential for managing cash flow by ensuring that there is enough cash available to meet the organization financial obligation. Secure funding. Finance and accounting are critical for securing funding such as loan or investment, as they provide lenders and investors with the necessary financial information to make informed decisions. Meet regulatory requirements. Finance and accounting are essential for meeting regulatory requirements such as tax obligation and financial reporting. Principle of finance. The principle of finance are the fundamental concept and guidelines that govern financial decision making, and the following are the primary principle of finance. Time value of money. The principle states that money received today is worth more than the same amount of money received in the future. It is because money can invest to earn a return, and therefore the value of money increases over time. Risk and return. This principle states that the higher risk of investment, the higher the potential return. Investor must balance risk and return to maximize their investment return. Diversification. This principle states that investors should diversify their portfolio by investing in the variety of assets to reduce overall risk. Cost benefit analysis. This principle states that the financial decisions should be made by comparing the cost and benefit of different options to determine the best course of action. Liquidity. The principle states that investors should consider the liquidity of their investment, which is the ease with which they can be bought or sold. Principle of accounting. The principle of accounting are the fundamental concept and guidelines that govern financial reporting. The following are the primary principles of accounting. Accrual accounting. This principle states that transactions should be recorded when they occur rather than when cash is exchanged. Matching principle. This principle states that expenses should be matched with the revenue they generated, regardless of when the cash is received or paid. Conservative. This principle states that when there is uncertainty about the value of an asset or liability, accountants should choose the value that is more conservative, which is the lower value. Materiality. This principle states that only significant information should be reported in financial statement, and immaterial information can be omitted. Consistency. This principle states that accounting method and principles should be from one period to the next to ensure that financial statement can be compared over time. Tools and technique of finance. Finance uses various tools and techniques to analyze and manage financial data. The following are the primary tools and technique of finance. Finance statement such as the income statement, balance sheet, and cash flow statement provide essential information about a company financial performance. Ratio analysis. Ratio analysis is a tool that uses financial ratio to analyze a company financial performance and determine its strength and weakness. Budgeting is the process of creating. The importance of finance and accounting in business. Both finance and accounting are critical to the success of any business organization. There are some provide information for making informed financial decisions. These include everything from budgeting, forecasting, invest decision, and risk management. Financial report is essential for transparency and accountability. It provides stakeholders such as investor, creditor with the information they need to make informed decision about an organization's financial health. Compliance, finance, and accounting are also important for ensuring compliance with regulatory requirement. This includes everything from tax compliance to financial reporting standard. The impact of finance and accounting on the global economy. Finance and accounting have a significant impact on the global economy. Here are some of the way economic growth. Finance accounting play a critical role in promoting economic growth by providing the capital necessary for investment. Finance enables business to expand and create jobs, which in turn stimulate economic growth. Finance stability. Finance and accounting are essential for maintaining financial stability. This includes everything from managing risk to ensuring compliance.